He's tried 11 different indicators in the last 3 years, 4 different brokers, 2 mentors who charged him thousands of dollars for courses he still hasn't finished watching. He's switched from Forex to crypto to gold and back again, convinced that somewhere out there is the missing piece, the one signal, the one setup, the one secret that separates the traders who make it from the ones who don't. Tonight he's staring at his screen again. Another red month closing out, another strategy about to get deleted from his charting platform. And somewhere in the silence of that dark room, a question finally surfaces that he's been avoiding for years. What if it was never the strategy? What if every single system he's ever tried would have worked, if only he'd actually followed it? That question is the reason you're listening to this tonight. Because almost every trader who's ever blown an account has done it while holding a perfectly good strategy in their hands, one they abandoned in the exact moment it mattered most. The traders who actually make it, the ones still standing after 5, 10, 20 years in this business, didn't find some secret formula the rest of us missed. They found something far less exciting and far more powerful. A small handful of rules they were willing to follow, even when every emotional impulse in their body screamed at them to do the opposite. Tonight we're going to walk through 5 of those rules, the same ones that quietly separate the traders who survive from the ones who disappear, one blown account at a time. The first rule is simple to say and brutally hard to live by. Cut your losses quickly. Nearly a century ago, a trader named Jesse Livermore learned this the hard way, losing and rebuilding several fortunes before finally understanding that the size of any single loss was never really about the market. It was about how long he was willing to sit inside his own denial before admitting he was wrong. Here's why this is so difficult for almost everyone. Human beings are wired with something called loss aversion, where the pain of losing money feels roughly twice as intense as the pleasure of gaining the same amount. Your brain doesn't process a losing trade as simple information. It processes it as a threat, the same ancient wiring that once kept your ancestors alive when they lost food or shelter. On top of that sits the sunk cost fallacy, the quiet, irrational belief that because you've already lost some money on this trade, you need to stay in it longer to make that loss mean something, as if holding on somehow protects the money that's already gone. And underneath both of these sits the ego, whispering that closing this trade means admitting you were wrong. And admitting you were wrong feels, in that moment, like admitting something about your worth as a trader. This is exactly why beginners move their stop-loss the second a trade turns against them. Not out of carelessness, but because moving it feels like protecting themselves from being wrong, when it's really just delaying a much larger loss down the road. A trader in gold takes a small, disciplined loss, exactly where his plan told him to, and moves on without a second thought, even though the trade would have worked out an hour later if he'd stayed in. He doesn't regret it, because he understands that respecting the exit consistently is what keeps him in the game across hundreds of future trades. A trader in Forex freezes the moment his position turns red, convinced it will reverse any minute now, and by the time he finally accepts reality, the loss is 10 times larger than it needed to be. A trader in Bitcoin watches a clean setup fail, exits immediately, and reviews it calmly that same evening, treating it as one data point among hundreds rather than a verdict on his ability. Be honest with yourself for a second. Have you ever watched a small loss grow simply because closing it felt like defeat, when closing it early would have actually been the strength? Protecting your capital was never about being scared. It was about survival, plain and simple, because a trader who accepts small losses lives to trade next week, and a trader who refuses them eventually meets the one loss large enough to end everything. The second rule asks you to change the way you think about being right in the first place. Think in probabilities, not certainties. Mark Douglas spent decades teaching this exact idea, and it remains one of the most misunderstood concepts in all of trading. Every single trade you take is completely independent from the one before it and the one after it. The market doesn't remember your last loss, and it doesn't owe you a win because you're due for one. Your brain doesn't naturally think this way. It's built to find patterns, to connect one event to the next, which is exactly why traders fall into recency bias, assuming that because the last 3 trades won, the fourth one is somehow more likely to win too, or that because the last 2 trades lost, something must be fundamentally broken. Neither of these assumptions holds up under real probability thinking. A strategy with a genuine edge can lose 5, 6, 7 trades in a row and still be perfectly healthy, because the edge only reveals itself across a large enough sample of trades, never in any single one of them. Confirmation bias makes this even harder to accept, because once you've entered a trade, your brain starts hunting for reasons you're right and quietly ignoring the signs that you might be wrong, simply because being wrong feels uncomfortable. Uncertainty is not a flaw in trading. It is the entire environment you operate in, and the traders who resist that uncertainty, who need to be right on this specific trade, are the ones who take it personally every time the market disagrees with them. The traders who accept uncertainty completely are the ones who can lose calmly, because they were never emotionally attached to any single outcome to begin with. Have you ever taken a loss and felt like the market had personally proven you wrong, rather than simply landing on one outcome out of many possible ones? If yes, you're not alone, and that feeling is exactly what probability thinking is designed to dissolve. The third rule is about protecting the only asset that actually lets you keep playing this game at all. Protect your capital before you ever chase a profit. Paul Tudor Jones built his entire career around this exact idea, understanding that defense matters more than offense. Because a trader who avoids catastrophic loss lives to trade another decade, while a trader chasing gains recklessly might not survive the next bad week. Behavioral economists Daniel Kahneman and Amos Tversky showed that people become far more willing to take reckless risks after they've already lost money. Psychologists call this prospect theory. Instead of accepting a controlled loss, the brain suddenly becomes comfortable, risking much more just to avoid locking in the pain. This is exactly why traders who would never risk 5% on a normal day suddenly risk 20% after one bad session. The market didn't change. Their psychology did. This starts with risk management, deciding in advance in a completely calm state exactly how much you're willing to lose on any single trade, and never adjusting that number based on how confident you happen to feel in the moment. It continues with position sizing, calculated before entry and never touched again once the trade is live, regardless of how badly you want to make up for yesterday's loss by going bigger today. And it includes a daily loss limit, a hard, non-negotiable wall that stops the bleeding the moment it starts. Instead of a soft suggestion, you can quietly talk yourself out of once emotions take over. A trader who ignores this builds one dangerous trade on top of another, doubling size after a loss, convinced the next one will fix everything, until one single session erases months of careful, disciplined work. Capital preservation was never the boring, cautious cousin of real trading. It is real trading. Everything else, the entries, the analysis, the indicators, only matters if you still have capital left to use them with. The fourth rule is the one that separates traders who understand psychology from traders who actually apply it under real pressure. Follow your system, not your emotions. Ed Seykota built his entire philosophy around this idea, believing that most self-destructive trading behavior comes from unresolved emotional needs playing out through the market, rather than any genuine strategic decision. This is where fear of missing out quietly convinces you to chase a candle that's already moved without you, where revenge trading whispers that you can win back a loss immediately if you just act right now, where overtrading fills your day with clicks that have nothing to do with actual setups and everything to do with restlessness. Underneath all of it sits dopamine, the same reward chemical involved in every addictive behavior, released the moment you imagine the profit you could be making if only you'd acted a few seconds sooner. And in the middle of an emotional spike, something close to an amygdala hijack takes place, where your emotional brain seizes control of decision-making before your rational mind even gets a vote, flooding your body with the same stress hormones your ancestors once used to survive physical danger. Over time, these emotional decisions become a habit loop. Trigger, emotion, impulsive trade, temporary relief, repeat. Every time the cycle repeats, the brain strengthens it. Professional traders don't simply break bad habits. They replace them with better ones until discipline becomes automatic. This is why intelligence alone never protects a trader from bad decisions. Doctors, engineers, business owners, brilliant people from every field have blown trading accounts, not because they lacked knowledge, but because knowledge and emotional discipline live in completely different parts of the brain. Discipline always beats intelligence in this business, because it doesn't matter how sophisticated your analysis is if you abandon it the moment your heart starts racing. A trader who follows his system, even on the boring days, even on the days it feels pointless, slowly builds something no amount of cleverness can replace. A track record built on consistency instead of excitement. Brother, be honest with yourself. How many of your worst trades came from a broken system, and how many came from a perfectly good system you simply chose not to follow? The fifth rule is quieter than the others, but it's the one that makes every previous rule actually improve over time. Reflect more than you react. Ray Dalio built his entire approach around radical honesty with himself, believing that pain combined with genuine reflection is what produces real progress, while pain that gets avoided or denied simply repeats itself in a slightly different form later. This means keeping a trading journal that tracks not just your wins and losses, but the emotional state you were in before every single entry and exit. Because the pattern behind your worst trades is almost never about the market itself. It means reviewing your mistakes honestly without spiraling into shame, treating each one as data to study rather than a personal failure to hide from. It means building genuine self-awareness, noticing the specific moments where your discipline tends to break, whether that's after 3 wins in a row or right after a loss, or late at night when you're tired and bored and the charts feel more interesting than they actually are. Professional traders don't improve because they're naturally more talented. They improve because they've built a habit of looking honestly at their own behavior, again and again, long after the emotional trade has already happened, when the mind is calm enough to actually learn something from it. Somewhere out there tonight, a trader is scrolling through his 10th strategy this year, convinced that this next one will finally be the one that works. And somewhere else, another trader is quietly reviewing his journal from an average, ordinary trading day, looking for one small pattern he can improve tomorrow. One of them will still be searching for a secret 5 years from now. The other one will have built something the first trader never will. Not a perfect system, but a version of himself who can actually be trusted to follow one. Brother, success in trading is rarely one brilliant decision. It's thousands of ordinary decisions where you quietly chose discipline over emotion. Here's the truth I want to leave you with tonight. The market doesn't pay traders for knowing the rules. It pays the traders who follow them when it's hardest. When the loss stings, when the boredom is unbearable, when everyone else seems to be winning without you, when your own ego is begging you to do the exact opposite of what your plan says. Profitable traders were never people with magical strategies. They're simply people who kept their word to themselves, one uncomfortable rule at a time, long after everyone else had already broken theirs. In the next episode, we'll uncover why overconfidence quietly destroys more profitable traders than losing strategies ever could, and why the moment you start feeling invincible is often the exact moment you're closest to losing everything.